Hi, I'm Mr. Simons. Here we are talking about monetary policy once again, and we're looking at the implementation of monetary policy. If we look at where we're at in terms of our plan, we've already looked at the cash rate and we've already looked at an introduction to domestic market operations, or DMO. In this video, we're going to look at the RBA entering DMO and making some changes. And then we're also going to have a look at when the RBA acts, then commercial banks follow. So we're going to tackle two steps in this video. So remember, the RBA can control the level of money supply in the short-term money market. What does this look like? So that the RBA can reduce money supply and it can increase money supply. And all of this takes place in the short-term money market. And that the way it moves money supply is through domestic market operations. Now, DMO is this process where the RBA, it either buys back, okay, so the RBA either buys back or it sells an asset. And this asset is known as a Commonwealth government security, which is a government bond. And it buys back the asset or it sells the asset from or to the commercial banks. And then in exchange for buying these Commonwealth government securities or selling the Commonwealth government securities, the RBA will change the balances in the bank's ES accounts. Let's have a look at how this works. Let's say that the RBA wants to lower the cash rate. To reduce the cash rate, remember, the RBA must increase money supply. To increase money supply, what the RBA is going to do is the RBA will buy back CGSs from the commercial banks. So the RBA buys CGSs from the commercial banks. If the RBA buys something back, then it's going to give the banks money. If I buy something from a shop, I give them money. So the RBA buys back CGSs, and in exchange, it deposits money into the bank's ES accounts. And this will increase money supply in the short-term money market. So remember, if the RBA wants to lower the cash rate, it needs to increase money supply, and it will do that by buying back CGSs from the commercial banks. And this will push down the cash rate. Let's look at the other situation. Let's say the RBA wants to increase the cash rate. To increase the cash rate, make a higher cash rate, the RBA is going to have to reduce money supply. If the RBA reduces money supply, the cash rate will be higher. So if the RBA is trying to take money out of the short-term money market, it will sell Commonwealth government securities to the commercial banks. So in exchange, when the RBA sells CGSs, the RBA then takes money out of the banks because that's what you get. When you buy something from the RBA is going to take money. That reduces money supply in the short-term money market. And what we can see when we reduce money supply is that we get a higher cash rate. So let's keep it going here. When the RBA acts, when the RBA buys or sells Commonwealth government securities, then commercial banks will follow. So the way we can talk about it is the RBA cash rate, it's like the foundation, it sets the basis for other interest rates in the economy. about it this way. If I get an increase in the cash rate, this makes it more expensive for banks to obtain funds in the short-term money market. If things are more expensive for banks, they will then pass on those costs to consumers. So if banks have, this will lead to, this is because banks are trying to maintain their profit margins. So if they have higher costs, they need to keep their profits up. So they're going to try and get more money from customers to maintain those profit margins. So an increase in the cash rate, higher interest rates. Let's flip the situation now. If the cash rate is lower, this makes it cheaper for banks to obtain funds in the short-term money market. So this reduces banks' borrowing costs, and they'll pass some of these savings onto customers. Not all of them, but some of them, in the form of lower lending rates. So if I get a lower cash rate, this will lead to lower interest rates. And this is partly because there's a bunch of competition that takes place in the financial sector. So any changes in the cash rate will lead to changes in the general level of interest rates, and that will affect economic activity. So that we see cash rate changes, interest rates change, the economy changes. So the cash rate is the instrument of monetary policy. And to change the cash rate, the RBA uses domestic market operations. Thanks for watching this video. We covered 2 big steps in this video. Please come back for the next video, which will conclude the exciting chapter on monetary policy. Subscribe. Have I told you to subscribe? Subscribe. Thanks for your time.